Ever heard of the stock market? Of course, you have. But do you really get how it works? Why do stock prices zigzag every single second? When you tap buy on your phone, where does that money actually go? And most importantly, how do regular people like you and me use this system to build real, long-term wealth? Stick with me, because by the end of this video, you'll understand exactly how the stock market works, and you'll have the confidence to start your own investing journey. First, let's clear up a common misconception. The stock market isn't a single building with a giant bell. It's a massive, global network of exchanges, like the New York Stock Exchange or NASDAQ, that connect buyers and sellers. And what are they trading? They're trading tiny pieces of companies called shares, or stocks. When you buy a share of, say, Apple, you're not just buying a digital number. You are now a part owner of Apple. You own a tiny slice of every iPhone, every MacBook, and every App Store transaction. If Apple succeeds, innovates, and grows its profits, your little slice of the company becomes more valuable. If the company hits a rough patch, the value of your share can drop. It's that simple. You're betting on the future success of that business. So, why would a successful company like Apple even want to sell off pieces of itself to the public? It all comes down to raising money. Imagine you start a killer coffee shop. It's so popular, you want to open 10 more locations. But that takes a lot of cash you don't have. So, you decide to sell small ownership stakes in your coffee business. This process is called an initial public offering, or IPO. Investors give you their money, and in return, they get shares. You use that cash to build your new coffee shops, hire more people, and expand. As your coffee empire grows and becomes more profitable, your investors' shares increase in value. They helped you grow, and now they get to share in the rewards. That's exactly what big companies do, just on a much, much larger scale. Okay, so we know what stocks are and why companies sell them. But why do the prices change constantly? 1 minute a stock is up, the next it's down. The engine driving all this movement is a simple, powerful force: supply and demand. Think of it like concert tickets for a superstar. If everyone wants to go to the concert but there are only a few tickets available, the price skyrockets. If the artist is less popular and there are tons of empty seats, ticket prices will plummet. It's the same with stocks. If more investors want to buy a particular stock than sell it, the price is pushed up. If more people are trying to sell than buy, the price falls. But what makes people want to buy or sell? It's a mix of logic, emotion, and future predictions. Investors are constantly digging through information to decide what a company is truly worth. They look at earnings reports to see if the company is making money. They analyze economic data, like interest rates or unemployment numbers. They react to big world news, new product launches, or even a single tweet from an influential person. Every single trade is a reflection of someone's belief about the future. The buyer believes the stock is going to be worth more tomorrow, while the seller believes they can get a better price today. All these millions of different opinions, all happening at once, create the price movements you see every second. Now for the part you've been waiting for. How do you actually make money from all this? There are two primary ways. The first is through what's called capital gains. This is the one most people think of. You buy a stock for, let's say, $100 per share. A year later, the company has done well, and the stock is now worth $150. If you sell it, you've made a $50 profit on each share. That's a capital gain. The second way is through dividends. Think of these as a thank you bonus from the company. Some stable, profitable companies choose to share a portion of their profits directly with their shareholders. They'll send you a cash payment, usually every quarter, just for owning their stock. It might not sound like a lot at first, but for long-term investors, reinvesting those dividends can dramatically boost your returns over time. Of course, we have to talk about the other side of the coin. You can also lose money. If you buy a stock and its price drops below what you paid, you'll have a loss if you decide to sell. This is the risk inherent in investing, and it's why smart investors don't treat the stock market like a casino. They think in terms of years, even decades. History shows us that while the market has always had its scary downturns and crashes, it has always, eventually, recovered and climbed to new highs. Patience is your superpower. Feeling a bit overwhelmed by the thought of picking the *perfect individual stock? Don't be. You don't have to. For most people, a much simpler and safer approach is to invest in ETFs or index funds. Imagine a shopping basket. Instead of putting just one item in it, you fill it with hundreds of different items from the grocery store. An ETF, or exchange-traded fund, is like that basket. For example, an S&P 500 index fund holds shares in the 500 largest companies in the United States. When you buy just one share of that fund, you instantly own a tiny piece of Apple, Microsoft, Amazon, Google, and 496 other companies. This is called diversification, and it's your best friend as an investor. If one company in your basket has a bad year, it's balanced out by the other 499 that might be doing great. It is a fantastic way to spread out your risk and grow your wealth without having to become a full-time stock analyst. So, how do you get started? It's easier today than ever before. You can open a brokerage account online in about 15 minutes. Many of them have no minimum deposit, so you can begin with as little as $50 or even $20. The key is to start, no matter how small. A powerful strategy is to invest a fixed amount of money regularly, maybe every week or every month. This is called dollar-cost averaging. When you invest consistently, you end up buying some shares when prices are high, and you buy more shares when prices are low. Over time, this averages out your purchase price and smooths out the bumps along the way. More importantly, it harnesses the magic of compounding. That's when your investments start earning their own returns, and those returns start earning their own returns. It's a snowball effect. The earlier you start, the more time your money has to grow and multiply. Someone who starts investing in their 20s has a massive advantage over someone who waits until their 40s, even if they invest less money overall. Before you jump in, let's cover a few rookie mistakes to avoid. First, don't chase hot stocks just because you see them all over social media. This is often driven by hype, not fundamentals, and you could be buying at the peak right before a crash. Second, don't panic sell when the market drops. Market downturns are a normal, healthy part of the cycle. Selling in a panic just locks in your losses. Successful investors often see these drops as a buying opportunity, a sale on the stock market. And finally, a golden rule: never invest money that you'll need in the near future, like for next month's rent or a down payment in 6 months. The market is unpredictable in the short term. Only invest money you can comfortably set aside for at least 5 years or more. Remember, the goal is time in the market, not timing the market. So, there you have it. The stock market isn't some exclusive club or a complicated casino. It is a powerful system that allows anyone to become a part owner in the world's most successful companies and share in their growth. It rewards patience, consistency, and a long-term mindset. With the right knowledge and discipline, it can be the most effective tool you have for building a secure financial future. If this video helped demystify the stock market for you, do me a favor and hit that like button, subscribe to the channel, and ring the notification bell so you don't miss what's next. In our next episode, we are diving deep into ETFs versus individual stocks and which one could make you richer. Thanks for watching, and I'll see you in the next one.